RBI placed its third bi-monthly monetary policy review on 5th August, wherein it retained its key interest policy rates, that is the repo, unchanged at 8%, and thus the reverse repo and the MSF remained unchanged at around 7% and 9% respectively. The RBI also left its CRR flat at 4%. However, it reduced its SLR ratio by 50 basis points. The HTM ceiling for investments was also reduced to around 24%. Much of these policy actions were in line with the market expectations. Thus, the key highlights remain the same, that the key interest rates were unchanged. However, the SLR was cut. Just ahead of the policy, the system witnessed significant liquidity tightness, with the money market rates shooting up significantly above the repo rate. So the industry players had lobbied for several measures, one being that there could have been some leeway in the daily maintenance of CRR balances from 95% to around 80%. The other could have been that the RBI could have increased the frequency of term repos, and the third being that there could have been an SLR reduction. However, the RBI drew comfort from the fact that the new government will stick to its fiscal consolidation mandate, and it will stick to its borrowing program, given the fact that the systemic SLR currently is way above what is mandated then, that is 22.5%, and the fact that credit growth is not as strong at around 13.5%. So the RBI believes that such an environment is quite conducive to set a platform for credit growth pickup as it moves ahead. And when the economy in the second half, that is the busy season for the credit growth, when it needs a pickup, that it kind of set a platform for such a scenario. So the RBI deemed appropriate to reduce the SLR as of now and provide a platform as the credit needs of the economy grow in the second half of the fiscal year. The fact also remains that RBI stated that the tightness seen in the money market was primarily because of three reasons. One being that the uncertain government balances, with the RBI, a small volatility in these balances leads to a significant impact in the money market. The other being that the call volumes have dropped substantially. Amidst such thin volumes, the volatility gets magnified. And the third being that much of the money market is driven by a few select players, 4 or 5 banks, which tend to take the rates, and hence the rates are influenced substantially. Thus, the RBI deemed appropriate that rather than taking any direct measures on the liquidity front, it undertook a structural reform, in the terms of SLR reduction, which would also cater to the credit needs of the economy. RBI has very well placed its policy, bearing in mind strong fiscal consolidation going ahead. It expects a gradual recovery in growth in FY15, albeit it has certain concerns on the inflation front. On the growth front, it states that it has projected its GDP projection between 5 to 6%, bearing in mind the central tendency of around 5.5%. It draws comfort from the fact that fiscal consolidation is on track. The current account deficit was contained pretty well in FY14. There is good accretion in terms of FX reserves with the Reserve Bank of India, and given the fact that our industrial pickup is showing incipient signs of recovery. So drawing some comfort on these factors, the RBI has stated its projection at around 5.5%. However, it is also giving some cautious outlook towards the downside risks. It states that in case the global tension, the geopolitical tension continues, in case the monsoon doesn't pan out the way it is, both agri growth could be impacted as well as the expenditure consumption economy could suffer, because of which it has also highlighted certain downside risks to growth. Overall, its projection remains intact between 5 to 6%. On the inflation front, it has highlighted several concerns. The fact being that the monsoon is uncertain, you do not know how the agri produce will be impacted by this uncertain monsoon, the elevated vegetable prices. In fact, it has also stated that with incipient signs of recovery, in case the demand side pressures start building up, there will be upside risks to the inflation projection. So your fan chart, the RBI's projection fan chart, shows some downward bias up till the month of September. However, it shows the fiscal year end inflation at around 8%, which is where it had actually projected. RBI's disinflation glide path states that it wants an inflation of around 8% CPI by Jan 2015 and 6% by Jan 2016. So the overall policy stance has two highlights. One being that it has dropped the categorical mention of the room of policy easing that it had stated in the June policy. In the June policy, that statement was taken very dovish, from the market participants. So the RBI has dropped that statement. On the other hand, it has included a statement which states balance of risks to medium-term inflation of the target of 6% 2016 are on the upside. So on these two statements and the fact that the RBI has retained a very cautious stance on its inflation front, the RBI chose not to do anything to the rates and neither provide any ease into the liquidity measures directly. Such a stance makes it very clear the RBI wants a pause in these rates for a considerable amount of time. We believe these rates will remain so at least up to the calendar year 2014, and we could stretch easily up to fiscal year end 2015.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.